Well, the Senate has now begun the final vote on the financial regulation bill. Steve Bartlett is president and CEO of the Financial Services Roundtable, which has members like J.P. Morgan, Wells Fargo, Fidelity Investments. And Steve is joining us from our Washington newsroom with his perspective on the bill. Steve, welcome. Thank you so much for joining us.
Julie, it's good to be with you.
So I guess bottom line, as this thing now gets set to pass, will it prevent another crisis if we see something happen like this again?
Well, that's probably the good news of it, is because it creates systemic risk oversight and begins to deal with the regulatory system as a system instead of silos. That's the best thing about this bill, is it will provide some systemic risk oversight and prevent another crisis. We think. We don't know what the next crisis will look like, but we think it puts some stability into the system. There's some negative things in the legislation also, but the systemic risk oversight is the best thing.
Well, when you talk about the systemic risk oversight, do you think regulators will actually use that oversight? Do you think they'll actually use the muscle they're being given?
Well, we hope so. This last round, what we discovered is that each of the regulatory agencies, of hundreds of regulatory agencies, just simply do their own thing and then didn't talk to each other. Didn't have the statutory authority to, I suppose, but they didn't. And the result is that you have loans being made over here and sold over here and securitized over here and insured over here, and none of the agencies talking to each other. So this legislation, this new structure, should create some sense of stability to that system, and that's what it's designed for, and we like it. There are some things in the bill that we think will cause some problems, but it's a big bill. It's 2,300 pages, and the new reality starts today. 2,300
pages. Have you read it, Steve? I'm curious.
No, only 2,192 pages. No, it is. A lot of people would say it's overdone. That is, there's more in there than ought to be, but it is what it is. Our industry, the financial services, we finance the economy. So this is the new law of the land. It's the reality, and so we will deal with it to turn to the business of financing our customers' businesses.
Now, we are hearing from a lot in the banking industry that they're pretty relieved at how this turned out, that they think it could have been a lot worse. Do you take credit for that, some credit for that?
Yeah, I probably wouldn't say it that way. I say it more that this is the reality, that there's some things in the bill that are really good, and there's some things in the bill that may turn out to be really bad. We have to still go through the regulatory process. But I would never take delight of legislation that is not as, quote, not as bad as it could have been. You want to get it right the first time, and I think the Congress got it right in a lot of areas and got it wrong in some areas, but we're going to deal with it. We're going to make it work.
Our Peter Cook has been following this, of course, very closely, and Peter, you want to weigh in with a question here for Steve?
I do. Thanks, Julie, very much. Steve, good to see you. Thank you for the time. My question is about the next step in this process. The regulators who have to carry out this law once it is signed by the president. What is the single most important decision by regulators that you are looking at that will affect your members? Is it bank capital standards? Is it something else? What is it?
Well, I'd really name two. I think the effect on credit through bank capital and derivatives and proprietary trading is one, and the other one is the interchange fees, which we think is an area that the Congress just got it, or the Senate got it profoundly wrong by putting price controls in. So we think those are the two areas: the credit availability and interchange fees, or debit card fees, that the regulatory agencies really have to take a look at and then come back and try to get it right so it'll serve the consumers well. Those are the two areas that we probably have the most concern about. But I have to tell you, there are 254 separate regulations called for in this legislation, and that's more than I can remember in my lifetime all combined. So it's a massive piece of regulatory structure.
How much are costs going to go up for your members as a result of all this, Steve?
Oh, I don't know that. Well, I think the cost will be the cost of the bureaucracy itself, because this legislation does create some new bureaucracies, and not only do we have to pay for those directly through the regulatory fees, but more importantly, if the bureaucracies encumber the system so that borrowers can't borrow or investors can't invest, well, then you have some diminution on the economy. So I think it's more of the cost to the economy than it is on our companies. I think our companies can make it work, but we want to make it work in favor of our customers, which are the people that we finance.
I'm also curious how much faith you have in the regulators that are out there. I mean, obviously, there are some questions about what the regulators were doing during the crisis, as their role everybody had a role, but their role specifically. But there has been some change in the regulatory structure and the personnel. Do you have more faith in the system now?
Well, I learned a long time ago not to personalize it, so I don't look at an individual person or a regulator and say, well, that was their fault. I think the system was badly designed and had been designed as a Rube Goldberg over the course of 75 years. So I think this statute will clarify a lot. I think not in every case. There are some places where it won't clarify, but I think this statute gives the regulatory agencies some additional authority that they didn't have. And they clearly didn't have it, and they didn't use it. So I have greater confidence that this legislation will reduce risk because regulatory agencies will be empowered to do that. Time will tell, but I think this moves us forward because it does end the uncertainty of what the legislation could be, and it also then gives everybody a chance to take a deep breath and then get on with the business of both the regulations but also the economy.
Steve, thank you so much for your time. I appreciate it. Steve Bartlett is the head of the Financial Services Roundtable.